31 exchange, which only applies to investment real estate. The second one I'm referring to is called a deferred sales trust. It works for primary homes. It works for investment real estate. It works for highly appreciated public stock. It works for private stock. It works for collectibles, artwork. It works for Bitcoin, cryptocurrency. And it's literally, I think, the best kept secret. And not only that is it's new to people, but it has a track record of thousands of closes now, right? At over 25 years, 15 times no change IRS.
My mind was blown, and it's too good to be true. It's too good to be true. My CPA would have told me about it. My commercial broker would have told me about it. No, we didn't know about it at Marcus Millichap until 10 years ago, and now we know it.
But I'll tell you, you made me a believer when we got the wire from our mutual client who made this work. And it was a real eye-opener to see that there are ways that people can use the regulatory framework, if properly structured, to invest 1031 exchange dollars in things that you would not think were like kind to what they exited from. So it was very impressive. I got to say, you are the first one I've seen pull this off, and I'm pretty what do you call it? Hesitant to believe in a lot of these kinds of things. So it's a major feat for me to say, wow, this actually really worked. And it was really cool.
So using the deferred sales trust allow them to hold on to those assets. I mean, obviously they're, the legal structures around them, they're not in their names, but now that chunk of money is a cow in their farm, a really nice cow that does some really amazing things tax-wise and allows them to get the income that they need in order to meet their expenses. It's going to extend the length of time that they're going to have income by a pretty wide margin.
1031 is a way to shelter your income when you sell the thing. The DST is a way to avoid the 1031 and not have to suffer the time penalty and free up your hand to negotiate at whatever time you figure is appropriate. And it allows you to sit on the sideline, or it allows you to accelerate when needed and accumulate your capital.
So I found you, just so your listeners know, on a podcast. And I'm like, wow, this guy is really leaned in. He's articulate. He's very smart. When I worked in 1031 exchanges, we didn't really talk much about DSTs. We just used them to sort of round out a 1031 exchange. And I never knew that it could be the only solution that you need for a primary resident to take their capital gains and defer it and put it into another property. That was like mind blowing for me to understand that concept, which I learned on the podcast that you were on.
Over our career and during different tax periods, we've seen, these tax avoidance, tax minimization, offshore, all these different strategies undertaken to minimize or avoid taxes. And then I can tell you that, some of them are just not worth the trouble. And so I was skeptical. Admittedly, I was skeptical. I thought, oh yeah, here we go, another one of these, right? And then they say, no, it really is different, right? So look more closely. We looked more closely. We had, honestly, 2 years of conversations. 2 years. Now we were being due diligence at the same time that we were doing due diligence, but 2 years is a long time to be, sort of flirting with the idea of and getting to know the people and getting to really understand the transaction. Yeah, long story short, we got comfortable, although we are not tax attorneys, lawyers, or estate planning attorneys, that at least, from an investment perspective, that, it made sense to sell a highly appreciated asset, get liquid, hold that in this type of a deferred or installment sale type of instrument, and then just be in a position then to do the most important thing. I'm probably stealing your next question, which is time. They say, well, you can't make more time. You can. The Deferred Sales Trust, in a way, allows you to lengthen the investment time horizon for those assets after getting liquid, but before having to feel the tax impact. And from an investment manager's perspective, time horizon is the most important element in investing.
Yeah, so I'd say be early and connect with us and just clarify your vision for what you want your wealth plan to be. And that's just not just your wealth, but that's your time and your energy. That's where do you think the market's at? Like, do you think it's a buyer's market, right? Do you think it's a good time to buy? Do you think it's a good time to be in debt? And if so, just keep buying real estate right now. But if you think it's not, and perhaps you want to wait on the sidelines and have some liquidity, get out of debt and wait for what we call a deal to hit you over the head, then that's why you would use the Deferred Sales Trust, regardless if you're a baby boomer or if you're a professional. But essentially, if you connect with us, we're going to help you map out a wealth plan. And as part of that wealth plan, we're going to write a line down the middle of a piece of page, and we're going to say, continue as you are with the 1031 exchange, or continue as you are with the Deferred Sales Trust, or a mixture of both. And we're looking at all of the pros and cons side by side, and then let you decide what's best for you. All right, everybody. Hey, welcome. Welcome to another capital gains cryptocurrency mastermind, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax options when it comes to selling cryptocurrency or other highly appreciated assets, businesses, or real estate. And our goal is to help you, whether you're selling cryptocurrency or a business or real estate, never have to feel trapped by capital gains tax ever again, be able to diversify your wealth, create more wealth, and buy at what we call optimal timing, which is simply this: buying when the market makes sense, right? There's a time to sell and a time to buy. In the last couple of weeks, we've seen why it would have been good to sell crypto, right, at a high. Hopefully, it does work its way back to some of the all-time highs, especially with Ethereum and Bitcoin. But we want to make sure that you have an exit plan so you can take advantage of those highs and then be able to reinvest back into crypto or real estate, stocks, bonds, mutual funds, diversify your wealth, and buy when it makes sense, dollar cost average. And that's the one thing that we're going to be talking about in this entire mastermind today, is the value of time, and the value of time as an investment horizon, and then helping you to clarify and create a deferred sales trust wealth exit plan so that, again, you never have to feel trapped by capital gains tax ever again. I'm here with my amazing two co-hosts, Pierce York and Jake Miller. Pierce is out of the Southern California area. He's with Kingdom Luxury Realtors. He's also with a part of EXP team with myself as well. And he focuses on high-end luxury real estate and using the Deferred Sales Trust to help clients not feel trapped to sell their houses using the Deferred Sales Trust. As well, I have Jake Miller, who is, I call him the CPA whisperer. He's almost like the tax deferral whisperer. He's a financial advisor. He's a CFP. I think he just passed a couple more financial advising exams. He's brilliant in the way he thinks and methodical, and a financial planner, business entrepreneur. So please welcome Jake and Pierce. Jake and Pierce, how are we doing, guys?
Doing great, having a wonderful time, and calling in from Mexico with the family on the beach. And if you hear the waves rolling in the background, it's not the CPA whisperer making noises. It's just nature. We love it that way.
Absolutely love that. Pierce, how you doing, brother?
Things are good. We're up and rolling. Got a wedding to go to this weekend. One of my best friends. So that's going to be fun, and excited to get through this.
Now, on a side note, Pierce might be having some other natural sounds coming from the new baby in the background.
I gave the baby to mommy.
Oh, very good.
Putting mama to work?
Yeah, about time.
And Pierce, that's your third baby, right? Third baby. So she's a pro at this, right? What's 2, 3? Wait, come on. What's the difference?
White noise after 3.
You know what they say? Like, having another baby is what you're already swimming and drowning, and someone throws you a bowling ball, right? And you gotta try to figure that out. I don't know what the saying is. Something like, I have 5. We're still trying to figure that thing out. Jake has, how many Jake do you have?
I have 3 kids.
3. Okay. So you and Pierce are on the same level there. So
yeah. And yourself, Brett?
Yeah, I have 5. We got 5 kids. So we're
so Pierce and I together, we have to team up to beat you. But other than that, we're good.
Yep. And by the way, Jake's out of the Midwest. He's out of Utah. I'm out of Sacramento, California. And I'll be speaking, and Jake may be joining me. I want to invite everyone to Colorado in February at the Best Ever Conference. And this is with Joe Fairless. It's, I think, what I hear, and I believe, I haven't been there yet, but the #1 commercial real estate syndication conference. So if you're a cryptocurrency owner or a business owner or anybody, and you're looking to sell and potentially invest in cryptocurrency, and all tax deferred, this is a conference you're going to want to be at. I'll be speaking exactly on this topic, which is selling cryptocurrency and investing into commercial real estate.
all tax deferred. So we want to invite you to that. I do have a discount code. And if you email us info@capitalgainstaxsolutions.com, we can give you that discount code. I think it's also on my social media on Facebook and on LinkedIn from about a week ago. I posted it on there. If I had the discount code, I'd give it to you right now. Maybe I'll bring it next week, but it's in February and it's going to be an amazing conference. So check it out. I think it's February 11th. Jake, do you know if you're going to make it for sure yet? Are you dialed in? You got your you don't even have to do Southwest flight. You could just drive there, right?
It's not too far away, but it looks like I have it blocked out on the calendar, and unless an act of God or something incredible happens, I should be there. Because if nothing else, that should be the incredible thing that happens that week.
That's a treat. And by the way, I think what we'll do is we'll work out on that talk if I can. I don't know how the format's going to be, but we'll figure something out. Maybe we'll get a sneak peek, get Jake on stage too. We'll see. But that being said, I also want to welcome Rebecca Munson, who is out of Truckee in Lake Tahoe. She's in luxury real estate, and she's one of our strategic partners. And also, Adam, thanks for being on here. So let's dive right into the vision. Jake, what's the vision for why we're here?
All those individuals that have highly appreciated capital assets that are going to sell or have some kind of taxable transaction, there's a way and a method, appropriate and legal, to defer those taxes going forward and reinvest the bulk or the gross proceeds of that transaction rather than net of taxes. And this is for every entrepreneur out there, or individual who, as a business owner or as an investor, would like to reinvest with more money and stop losing a big chunk of their investment every time they buy and sell.
Pierce, what amount are we talking about here? If someone were to sell, what's kind of the percentages? What are we talking here?
Typically, you want $1 million of gain and $1 million net proceeds going into the trust.
Yeah, to make it make sense. But what are they up against? Why is that? Like, what percentage would they be paying if they bought a Bitcoin for $1 and it went to $1 million? What percentage of that typically would be paid in capital gains tax?
Depends on your state, but in California, typically 37 to 50%, depending upon your income levels and everything else that's involved in that super complicated tax code, which is why you should definitely reach out and call us so you can verify.
Yep. And then that 50% could be as depreciation recapture. So it wouldn't be necessarily applicable to crypto, but for a business or real estate, it could be. State is about 13.3 for California. It's about 20 for federal, right? And so that is, and then you have Obamacare of 3.8. So all these things kind of, we have to say 30 to 50%. Generally speaking, no matter where you live, it's about that. Could it be a little bit lower if you're in a state that's a little more favorable? It could. But also Biden's proposing to do what, Jake? Increase the capital gains tax to about how much do you think it's going to go?
I mean, let's just double it. I mean, my goodness. There's just a lot of things that are going around.
He'd like probably to do that, but I don't think it's quite going to get passed. But I think it's from 20 to 25 or 26 or 28, Jake. Is that right?
From the legislative tweets to what goes into the actual writing, there's a big difference, right? Either way that we go with this, they're trying to increase it. And that makes what we're doing even more appealing. A lot of people that we've discussed in the past, they have to weigh the pros and cons based on the amount, whether it makes most sense just to pay the taxes now and be done with it. Or, if they really want this executive team of, Brett and myself to be helping them going forward, everything else, it helps our case with this strategy. More and more people, it makes more sense when the taxes are going higher. And that's what's going on right now. Nothing is set in stone for 2022, but there's definitely a lot of movement towards increasing it to 25, 30. And of course, there's been several conversations of it going up to 40, but not necessarily next year.
Yeah, and to that point, with Pierce was saying $1 million net proceeds, $1 million gain, and what Jake just said, as the value of the deferred sales trust is in direct proportion to the tax deferred, right? In other words, if you have a $10 million sale and you're only paying $1 in tax, you don't need us, just pay the $1 in tax. But if you have a $10 million sale and you have $3 to $4 million of tax, then hey, defer it and use the deferred sales trust. We'd like to see that ratio somewhere between 25 to 30% of the tax liability deferred versus the actual equity that's closing. That's kind of a healthy ratio. And that would be like a 10 out of 10. That's why we typically have $1 million gain and $1 million net proceeds to make sure that we get to that level. We also found that this is a business trust, which means it needs to sustain itself, which means it needs to scale and be able to pay for fees. We have minimum fees. And like anything, the bigger you grow it, the more it can scale. And so as a general rule of thumb, if you're wondering, well, why is it $1 million net proceeds, $1 million gain? It's because it's a business. Like we got to literally see, like if you're an apartment owner, right? And you're like, well, I don't want to buy a 2-unit. I want to buy a 100-unit apartment complex because I can hire a full-time property manager, right? I can hire full-time maintenance staff. I can scale my expenses and my operations to make sense of the business. That's the same way we approach this trust with a commercial real estate, financial planning, mindset, right? Business mindset, entrepreneur mindset. And that's what we found as a 10 out of 10. So if you say, well, Brett, what if I have crypto that's only 500,000? Well, we have some clients we're working with where they have, $1, $3, $5, $10, $20 million. One has over $100 million right now. And we're going to be dollar cost averaging. And our general rule of thumb is if you think that you're going to get to $1 million over the next 3, 6, 12, let's say 24 months, it's not like a perfect art and a science here. It's kind of a mix of both. Then start with the smaller amounts and then build it up, right? But if it's just one asset that you're selling, like a single family house, like I had a guy call me yesterday and he says, I have 12 single family homes, and he's kind of in the middle, and it's a nice deal story to consider right now. And that it's 2.4 million. His average average price is 200,000, right? There's 12 houses, right? 12 times 200 is 2.4 million. And he has no debt. But I said, what's your basis, right? And can you sell them all to one buyer because it's in one transaction? That would lower your cost. Cryptocurrency is a little bit different in that we can do multiple coins and we can do it quickly over time. So we're still kind of massaging that. But generally speaking, $1 million net proceeds, $1 million gain over just a couple transactions. That being said, we're working with another client right now. She has about 2 million of cryptocurrency and about 40 coins, but the majority are about 15 coins of her bigger holdings. And we're exploring ways to do that succinctly with an LLC framework. And you can learn more about that at capitalgainstaxsolutions.com. And we can do one-on-one consultations. So everyone's a little bit different, but I want to dive back into the theme of why we're here on regards to for today, which is time. So the time horizon, Jake mentioned a little bit, the ability to take money before tax, just like an IRA or 401k, or even like a 1031 exchange, and roll it and continue to have it grow and build. That's one aspect of time. The other aspect of time, though, for example, maybe Pierce, you can jump in on this, is the ability to get your time back to where you want it to be. In other words, one of our cryptocurrency clients for Jake and I, her time was being spent working for one of the big 5 tech companies in the Silicon Valley and building their dream. So a lot of her time and energy and expertise and brain power spent building Google's dream. Now she was able to defer and sell about 5 million of Bitcoin. And now she has all of her time back. In other words, she has an income stream coming off of the trust, which means she never has to work for Google ever again. It's Google, by the way. And now has a chance to build up her dream and her business with one of her good friends from a long time. So Pierce, I want you to apply that now to someone who's in a luxury primary home in Newport Beach, right? And Laguna Niguel and Dana Point, the area where you're focusing on helping people sell their luxury homes. They've been in there for 20 or 30 years. So what is the value of the Deferred Sales Trust for time for them?
I mean, the value of the Deferred Sales Trust for them is the fact that, I mean, as far as their time is concerned, it depends on what they want to do. But if they're trying to, one of my marketing plans right now or strategies is to go after people of a certain higher age, the 65, the 70s year olds in 2-story homes who have a lot of equity in their house, because there's a good chance that they want to downsize and capitalize on the equity in their house. But if they end up selling and they're way past their 121 exclusion, then they're going to get hit. And then they have to wait, 5 more years, whatever it is, right, to net the same amount that they would net if they would just save the tax and do a deferred sales trust.
Hey, Rebecca, what's the 121 exclusion? Thanks, Pierce. I'll come back to you in a minute. What's the 121 exclusion for our listeners who don't know?
Sure. So if you live in your home, your primary residence, for 2 out of the last 5 years, the government, the IRS, allows for single people $250,000 worth of deduction, and for a married couple $500,000 worth of deductions.
Perfect. We just
from
I
your
just did
deferred
a
sales trust.
primary home in Palo Alto, and it's the
Yeah.
exact thing. He had a house that he was single, and he sold it for 8.3 million. So above and beyond his 121 exclusion, which is 250 of the gain, is basically tax free because he's single. It would have been 500 if he was married, but his 5 kids are gone. He's single, huge house, and exactly right. And he's I think he was over 60. Yeah, I think he's late 50s, over 60, and he wanted to relocate out of California and do some other things. So Pierce, back to you now on that timepiece. Beyond just the financial thing, what other things could people want to do with their time if they can relocate? What do you think they might be doing with their time and energy?
Well, I mean, they could retire. They could golf. They could give to charity. They could do, whatever it is that they want if they are able to capitalize on it financially and then cash flow, and it will give them financial freedom essentially to go out and do what they want with their time instead of putting it towards whatever job they have or putting it towards, their business or whatever the case may be, right? They're able to just expedite it.
Perfect. And so cash flow in this scenario equals time, right, Jake Miller? Because the house itself was highly appreciated, or the cryptocurrency is highly appreciated. And you might be staking some cryptocurrency, but the challenge with that is it could drop rapidly, and now you're have a margin call or something else happens there, or something along those lines. And a primary home, it's not producing any cash flow unless you're doing some cryptocurrency mining, and if you're in your 60s, you may or may not be doing that.
Yeah, I had a great conversation just yesterday with a fellow who, it almost sounded too good to be true. He was looking at what he had, and he said, "I've got this piece of pie, and I want to make my pie bigger. But every time that I want to reinvest it in the next great thing, I have to sell what I currently have. And every time I sell what I currently have, I lose a big chunk of it. So how do I go from this pie and shrink it down and then make it bigger?" I mean, it's just a lot more challenging because you got to take 2-3 steps back before you can go forward. And I asked him, well, what if you could take a leap forward rather than 2 or 3 steps back before moving forward? And he said, well, that's what I want. That's why I'm here. And I said, well, that's what the DST does for you. The DST allows you to take your pie and exponentially grow it net of attorney fees rather than net of taxes as you go forward.
You nailed it, right? And so time is your friend. And it's one thing we can never get back, whether that be your time with your energy, with your grandkids, moving out of a big home or traveling or retirement. And this cash flow, if you can take an illiquid asset or a highly volatile asset and put it into a consistent, dependable cash flow, diversified over stocks, bonds, mutual funds, real estate, cryptocurrency, a new business venture, ground up development, hard money lending, right? Have predictable cash flow. Now you no longer have to trade your time, your energy, or your stress for cash flow because this trust is doing that for you, right? And so that is the value of the deferred sales trust. And so I love the way you put that, take a leap forward versus 2 or 3 steps back, because honestly, that's where most people, and in 2008, the crash, they took like a tumble back, like they rolled down the entire hill, right? The 2008 to 2011. And part of what we found is because the 1031 exchange, which by the way, doesn't work for cryptocurrency, doesn't work for a primary home, doesn't work for business, okay? Works for commercial real estate investment property. But this is part of the origin of story of the deferred sales trust, and that they were trading, building. And then a lot of people lost half, lost all, and had to crawl out over the next 5 to 7 years and just barely break even. And because they knew they should be selling in the 05, 06, 07 market. I mean, I feel like 90% of the commercial real estate world knew, but they felt trapped by the capital gains tax and they couldn't stomach paying the 30 to 50%. And so they did the 1031 exchange, not knowing that the thing would fall apart and the wheels of the bus would fall off. And they'd have to be walking on the side of the road for a while just to catch another bus a couple of years later, right? So all that being said, the deferred sales trust eliminates the need for the 1031 exchange, but it also works for cryptocurrency, businesses, real estate, primary homes, and it helps you can take a leap forward when it makes sense for you. And that's really what we call optimal timing. Our parents taught us to sell high and buy low, not sell high and buy higher, or sell high, get hit with the tax and have to wait around and buy again and do that song and that dance. So that is the value of the deferred sales trust. Any other thoughts on that, Jake? Anything else to add to that, Pierce?
One of the other aspects of the time advantage here is the flexibility. I think being in control helps in a number of different aspects, and in some respects can even be more powerful than the longevity or the time value of money, in the sense that you get to choose not only the growth direction of your asset. You get to choose what types of assets. You can bounce in and out of various asset classes. It doesn't have to be the same thing. And most importantly, you get to choose when to get out. That is the big important thing. Sometimes we are given choices and it's a yes or no thing. With the deferred sales trust, it's a yes or no and a when. And that's incredibly important, because the market might be up with real estate and it might be time to sell that house. You might be having an amazing year and you have a lot of other taxable events, and it might not be a good time to incur the capital gains tax right now. So the deferred sales trust allows you to incur that transaction to sell now, sell when the market's right, sell when there's the right buyer. Same thing if you're a business owner. I just spoke to an individual who owns a very large tax practice, and his succession plan was his son. His son not only was an accountant, became a financial advisor and a CPA, and tragically died 2 months ago. And so everything came tumbling down. And subsequently, the individual also spent some time in the hospital with COVID, and just had to rethink everything that was going on as far as his business projection, and wanting to work another 7 years and then retire. Now things kind of got advanced and pushed forward, right? With something like this, with the deferred sales trust, I mean, shoot, if he's having an amazing year, it might not be a good time. Or what if he can't find the right buyer? Or what if his current plans change? With the deferred sales trust, he could actually sell it now and not incur all of those taxes this year, when he has a lot of other taxable events, because he's had his best year ever, right? And he can move forward and decide when to take those distributions, when to pay things out for himself, or how to reinvest it going forward, so that he leaves a really nice legacy for his heirs.
Fantastic.
So,
keep going. Sorry, Jake.
No, I was just going to say that when you have control over the when, it allows you to do proper planning, and it's a lot more likely that you achieve those results that you're seeking for in life.
And it makes the how easier too, right? When you have control over the timing of the when, it makes the how easier. But when you're squeezed with life and health and challenges and tragedy, right, the how becomes very, very challenging, right? And it's like if you have a big enough why, the how gets easy, right? Emotionally, you can forge through and persevere through the how of the challenges of the how. If you have a really big why, I'd like to coin the phrase with Jake here: when the when is flexible or is not under pressure, right? The how also becomes easier, right? Because you can take your time, right? I'm thinking of like golf, right? The analogy where you're getting up, and if you're playing like a scramble foursome, and people are, someone's behind you and you're rushing, right? You tend to, go through things quickly and maybe not have such a good hit. But if you can relax, stay calm, not feel pressured, relax your emotions, your timing, and get everything lined up, right? And you're going to be more highly successful on the how there. Rebecca, I want to bring you in here on the flexibility of timing as it pertains to passive or active investing. So for those who are selling their high-end primary homes or cryptocurrency, right? And maybe they want to be completely passive. What is the availability with the deferred sales trust? What would that look like for somebody?
Gosh, they have lots of options, which is great with the deferred sales trust. You caught me tongue-tied this morning, so
what options are there? Like, they can put it into stock market, they can put it passive real estate deals, they could do active real estate deals. I mean, you guys are selling your luxury home that you and your husband are building.
Yep.
Right. By the way, did you get those windows in yet? What's the deal?
No windows yet. It's there's plastic up. Yeah. There's a lot of things going on in the world today, and so things are a little delayed.
You think you could? By the way, is the market so hot, Rebecca, that you think you could sell a house with plastic windows?
Probably. It's probably
what kind
not
of discount are you going to get there? What do you think?
Yeah, I don't know, but that's a thought. I don't know if it's quite that hot. You know, it is cold in Truckee. It's actually like, super cold today. So you do need windows.
Yeah. So you can go into stocks, bonds, mutual funds, passive real estate. And so for someone who has a high-end home that wants to get out, defer the tax, turn that into cash flow, because Robert Kiyosaki says, well, right, our house that we live in is not an asset. It's actually a liability, right?
And his definition of asset, and I tend to agree with it, it's that it's cash flow producing, right? So again, my wife and I and kids, we started a new hobby, which is cryptocurrency mining. And my buddy had a good quote. He has about 10 rigs, and these rigs are basically mining Ethereum. And he said, look, you get 10, you instantly turn your house from a liability to an asset, because it can produce this cash flow via Ethereum. Now, Ethereum has dropped a little bit, so it's not as hot as it was just a month ago, but we think it's going to come back strong. But the ability to have something that was either illiquid or not producing cash flow to turn around and produce cash flow, to us that equals time. I think we've belabored that point. That makes sense. Andrew, I want to welcome you here. How are you doing today?
I'm well. Good to be back. How are you, Brett?
Hey, I'm doing well. Now, Andrew focuses on passive wealth building through multifamily value add properties. Andrew, what are you seeing out there? Have you guys got anything under contract here recently? If so, what was it and what's it looking like?
Yeah, well, we just closed on an asset that's 243 units in Atlanta back in October. And then we're actually back on the hunt right now and submitted out some LOIs just this past week. And I think we're going to put one under contract in the next week. Similar stature, also same market. But, you know, what we're seeing is a very competitive market, a market in which insiders have an advantage, right? So if you know certain tricks, whether it's certain people, certain relationships, ability to close quickly, it gives you an advantage. And if you know, in this context, if you know certain legal transactions that give you the ability to close more quickly or choose your times, you also have the advantage too. So it's all about education, and relationships is what we're seeing.
Good. And what about for you guys? I'm curious, when you guys accredited investors, I imagine, right, for your deals, what's the average investor investing? 50,000, 100, 250?
Yeah, we have a minimum of $100,000 on our most recent deals, right? So they have historically been 506B deals, B as in Bravo, which means that you could have non-accredited investors come in. Having said that, even in that scenario, we have about 80% of our investors are accredited. And we are having conversations about whether we continue to do Bs or whether we switch to Cs, which would be accredited only. And that would allow us to advertise or market the deal more broadly out to the big wide world. So there's a lot of pluses and minuses in that. I won't get into all the minutia there, but that's something that we're talking about. And it does impact who can come into our deals. Yeah.
I'm curious, what's your average investor size? Like, I know 100's the minimum, but you say average is 100, 150?
Well, right. So there's two different questions there. There's average and then there's median. I think if I remember my high school math, right? But we had a $2 million investor in our last deal, right? And so he's going to throw off the average. But I would say if you really want to go average, it's probably like 160K, something like that. There's a lot of people that simply are going to do your minimum, right? And what because I think we were at 50 at one point in time, then we were at 75, and then we were at 100. And a lot of people just kind of drift up with you based on that number.
Got it. Now that 2 million, I'm curious, let's dive in on that a little bit. So did you guys do a carve out TIC 1031 into your deal, or was this 2 million just cash? It came free?
It was just cash. It was not a TIC.
Got it. So now let's walk into that. Where did the 2 million come from?
I honestly, he's a business owner. So I think it's just at some point in time, his business is just generating a lot of cash. But it wasn't like he sold a home.
Got it.
It wasn't like he sold a small apartment building.
Or cryptocurrency for 3-4 million and paid tax and then had 2.
What's that?
It wasn't like he sold cryptocurrency for $3 or $4 million, whatever, and then
had 2. Honestly, I should dig into it more. My partner has more of the relationship with this person than I do, and so I just I don't want to muddy the water by kind of
for sure
going that relationship. So
that's what I would encourage you to do, right? Because here's the key, right? What's the story behind the money? Because he might have friends and family. In fact, we just closed a deal 2 weeks ago for a dentist out of New Jersey, and it was about a $2 million sale, and we deferred a bunch of tax.
Yeah.
And guess who just called me yesterday? One of their good friends.
Right.
And so knowing the story behind the money, and I know you would if it was your direct relationship, right? So, but it's your business partners, right?
Right.
It can help us solve the problem in advance and be like, hey, where did it come from? Well, in this scenario, it doesn't sound like he sold a business or real estate or crypto, so it may not be a moot point. But if you said, hey, what is the story behind that? Like, why wasn't it invested? Where did it come from? Was it a windfall?
Right.
Because $2 million is a lot to accumulate that's not under management or being worked on, right? Which is great. Right.
Now, if in fact he did sell something and pay the tax and net $2 million, right, had a big windfall,
Right.
then that's perfect to say, hey, I know this is bad to tell you now because we're still going through the due diligence and learning about this, what, all the things. But, and if you have friends or family, and or if you have another one that's coming up like this, let's do the scenario here, right? What did you sell? What was the basis? What was the gain? What was the tax you could have deferred? And what would that mean for Andrew and his team, right? For even more capital to manage, right? Does that make sense, Andrew? Any thoughts on that?
Yeah, absolutely. I mean, our mission as an organization is to generate freedom so that together we can make a difference. That's what we say, right? And so that second part of the mission means we're trying to make a difference together. And we want to generate freedom, not just for hyper wealthy people, because in a sense they already have freedom, but for kind of average Joe six-pack. So on that standpoint, we're trying to still cultivate the $50,000 investors, but we realize, to your point, Brett, that it makes a lot of strategic sense to be finding $5 million investors, $2 million investors. That'd make our life a lot easier. So we have ways in which we're trying to solve that, which I won't delve into the details on. But if you can solve that $2 million investor's problem, he probably has a couple other ones, just like your dentist, that are like, he's going to call his buddies. Hey, guess what I learned, right? So we're obviously trying to be more intentional about cultivating relationships with our high net worth investors and really trying to solve their problems. So I'm actually texting with someone who's got $16 million in a 1031 exchange right now, and he's trying to find an asset that he can put it into. And I know that he's I think 10 days into his 45-day window. And what he wants as far as year one cash on cash is something that I cannot provide. I'm like, listen, man, I would love that too. But, I'm not aware of unicorns. I'm not aware of pots of gold at the end of rainbows. I'm not aware of year one 12% cash on cash returns. Sorry, so that's a conversation he and I are having. But he may find that, on day 40, he's willing to take lower numbers. Or he may find on day 40 that, gosh darn it, there's something called a DST that might solve his problems too. So, if you can have those relationships and you can solve their problems, you're going to find more investors and more trust.
I absolutely agree. And let me dive into that a little bit more, right? And maybe this is a good question to ask him. Maybe you have, but let's kind of role play here. So if I were to say, Andrew, like, what is it about that 12%? Like, that's a great number, but what's the why behind that? Because in a 1031 exchange, the whole entity must move, meaning that entire 16 million must move into the next likely single property, sometimes two or three, but most people buy one and buy another, right? So what is it about when he says, I want that 12, and that perhaps it's a security thing? I mean, of course, it's always a return thing, right? And we always want to shoot for higher numbers. But
right.
Did he give you any inclination of how and why is it the 12? Is it arbitrary, or is there anything behind that?
Yeah, I mean, the short answer is he didn't give me. I didn't really ask that question, so I didn't get the answer. It's a great question, Brett. But I think it's just a security thing, right? Like, obviously, when you have $16 million, at some point, growing at another 16 is less important than not losing the principal. And cash flow is a metric of the safety of an asset, because even if the paper value of the asset goes up and down, if you're still getting cash flow, it's just a paper loss. But your cash flow is still coming in. You're still paying the mortgage with the cash flow. So I think it's a safety thing. That's my guess.
Okay, so let's talk about that. So you say, okay, if there's a way to lower your risk, to diversify your investment, to dollar cost average into multiple multifamily syndications, would that be of interest to you? Would you be willing to trade some of that 12, maybe to an 8 or a 7, if you knew you could dollar cost average and buy slowly, maybe do hard money lending, maybe keep it in the bank, maybe do a little bit by yourself, maybe do a little bit of development? Like, I mean, just say, is there a way to help you to get to closer to, and by the way, we probably can more likely get to that 12 if we have unlimited time, right? And we can more likely hit that 12 if we can diversify and not have to take so much risk all into one deal. Because again, the biggest challenge with the 1031, what does Down Lake sell for? What was the price of that?
What it is
Down Lake, the property that he sold, the relinquished property. What did he sell?
I'd have to look at the numbers. I don't know off the top of my head.
Okay. Do you know if he had debt on the Down Lake when he sold it?
I don't.
Okay.
Yep.
Okay, so those are good things to figure out, right? Because then you can fully. I just watched this this documentary on Netflix. It was called they're solving the Rubik's Cube. Anyone see that yet? There's like these guys that are like brilliant. You know, like you see the spelling bees where they get up there and they're like they can literally like spell the craziest words. Or there's the same kind of kids, but they do Rubik's Cubes and they go like this and they solve it in like 6 seconds. You're like, what? And they do it again and they do like bigger ones. And I want to encourage everyone who's on here, and hopefully I'm challenging Andrew here, right, to think beyond and the single colors on one side, right? And say there's multiple colors, and sometimes the client doesn't even know it, right? They don't even know it. And another color, another edge of it to try to line up the box, right, by moving all the colors around to solve the problem, is the estate tax, right? That's the big elephant. Like literally, you can try to defer capital gains tax and get the 12%. That's the tiger by the tail. That's important to get a hold of. But what the big elephant is just sitting there is this estate tax, and it's 40%. So one of the other questions, Andrew, you want to ask him is, hey, how much of that $16 million is inside of your taxable estate? Oh, hey, by the way, what is the size of your taxable estate? What is your estate tax strategy or plan to make sure that your family's not getting hammered with 40%, which remember has nothing to do with the stepped-up basis. The 1031 cannot solve estate tax challenges. He might say, well, I've been doing some gifting, Andrew. Oh, that's cool. Are you charitably inclined? Yeah, maybe a little bit. Most answers are yeah, somewhat. But more than likely, especially if he's commercial real estate, like the client I have in Colorado who just sold a $5 million multifamily property, they were $25 million net worth, and all of it was inside their taxable estate. So I'd be surprised. You never know, but I bet a majority of it is, and a majority of people who built wealth in commercial real estate, a lot of it's they can't gift it out fast enough. They don't have enough kids, right, and they haven't bought enough life insurance. And you can say to them, hey, look, what if there's a way, well, I can't give you the 12, but what if there's a way to get you the 7 or the 8 or in an IRR of 13 to 15 over 3 to 5 years or whatever it might be that you guys have, diversify your wealth and move the funds outside your taxable estate, which saves your estate, your legacy 40%. So all of a sudden you've changed his mind from focusing on that 12%
right
to, wait, you're going to look at me 40 over here? Yeah. So the big domino, in other words, is the 40% estate tax, death tax. Yeah. And he's looking at this small domino, not knowing this. Right. I mean, he might know the big domino, but he figures he has no solution for that. So you knock over this big domino.
You're basically saying that he's asking the wrong question, right? He's focused on the wrong thing. And the way we help is by sharing, hey, you're focused on this, but the bigger picture is over here.
You got it, right? The big domino, and the way Russell Brunson puts it in Expert Secrets is like once you knock over the big domino, everything else becomes irrelevant, right? So what is the one thing or the one question or the one thing that you could solve for on this Rubik's Cube? What's that one side that once you solve for that, the rest of it becomes irrelevant or just less? It's not that it's irrelevant to get 12 versus 8 or 9. That's still relevant, right? We still want to try to do our best. But now that you're saving me 40, oh my gosh, Andrew, thank you. You just added so much value. Now let's go do that. Now let's still try to get that 12, right? And I still think, if you can buy right over time and you can dollar cost average, which again, remember time is our strategy here, this whole episode, this whole mastermind. When we can give time back and not have to force 1031 exchanges into small peg holes, right? With the square peg, like it's great. So any thoughts on that? Andrew, or even Mitch. Maybe we can bring Mitch in here too.
You're muted, Mitch.
I was just saying I don't know too much about too much. I caught you on the tail end of that.
No problem. We'll bring Rebecca in. Rebecca, what do you think?
So I'm just learning about the estate tax here, but I love the logic. I love that you use the Rubik's Cube analogy. I love that. A lot of people don't know about the Deferred Sales Trust. So if you can solve one problem and it opens up so many other opportunities for a client, I think it's awesome.
Excellent. Thank you. Pierce, what do you think? You guys are all muted.
Yeah, I think the estate tax, like you said, the elephant in the room is the estate tax. One of the things I've definitely noticed is that conversation's a lot easier to have when you've already provided a lot of value. So that's one of the things that I've noticed is like, if I go in there and just try and tell, some dude who has $100 million sitting in the bank, like, hey man, like I can, save you so much money. You know, he's gonna look at me like, you're a punk. Like, what are you talking about? You don't know. You know, so it's kind of, that's my biggest challenge right now, is trying to figure out, okay, how do I talk to them, provide value so that they trust me enough to just give me a second to listen to what I have to say, and really just tee them up to get them on the phone with somebody else who's even smarter than I am. So that's the goal and the strategy. But I mean, yeah, it's I just don't understand how it's so valuable, and people just don't know about it. It's crazy. We have such a blue ocean. It's unbelievable.
So let me give you a little feedback for that, right? So since 2009, that has literally been the battle that I've forged, right, against the old school mindset of 1031 exchange brokers and companies and owners, and we've seen the success shift as we tell a better story. Right now, it's evidence based. And it's a story. So everyone in their minds have a story about why their CPA is the smartest CPA and why it can't be done, and they would have known about it. And that's the story they have in their minds. And we don't overcome people, or we don't help people overcome false beliefs through logic. It's through emotion. And the way we help people to have an epiphany or work through that is by telling a better story than the current story that they have in their mind. So case in point. And this is my number one secret to overcoming the biggest objection to the deferred sales trust. Like, this is too good to be true. My CPA would have known about this. And this is the story. There's a gentleman named David Young. You might say, who's David Young? Well, David Young partnered with a guy named Bill Gross. Who's Bill Gross? Bill Gross is like a Mark Cuban of the financial advising world. David Young, and about 4 other guys built PIMCO from the ground up about 20 years ago. So these are some of the smartest minds in the world when it comes to financial advising and money management. And PIMCO is one of the most respected. They took it from 80 billion to 1.2 trillion. They're like the rock stars, the LeBron James, the Michael Jordans. Like, Bill Gross is like the most amazing guy, respected on the financial advising world. And a lot of cryptocurrency or commercial real estate people, we don't even know about this guy, but he's very, very smart. So that being said, they get approached and they manage money for some of the top wealth in the world, and they get approached with stuff all of the time. And all of the time, I mean, constantly, people say, do my tax deferral strategy, do this thing for your clients. Why? Because they want to get access to their clients and all of their wealth. And so about 15 years ago, after they became Hall of Famers, is the way I call them, Hall of Famers in their world, they retired from PIMCO. David Young and 4 other guys who were running with him and Bill Gross, they formed a group called Anfield Capital. So Bill Gross is not a part of Anfield Capital. He's still retired or doing something else. But they get approached with the Deferred Sales Trust. Anfield Capital did about 3.5 years ago. And like most people, they're skeptical. And they say, you know what? I'm willing to be open-minded and see if this thing works. Apparently at that time, which is now 25-year track record, perfect. At that time, it's about a 22-year track record. And so they start to do due diligence. And that's what they're masters at doing, by the way. What they're masters at doing is looking at companies and looking at cash flows and essentially trying to predict markets the best they can to manage money for pension funds, wealth funds, and they're the best at what they do. So they don't do a 2-day due diligence or a 2-week due diligence. They do a 2-year due diligence on the Deferred Sales Trust. The banks, the clients, the structure, they sign the NDAs. They have their legal team look at it. They fly back and they meet with the tax attorneys, my business partner, and go through it all on a big whiteboard table for 2 days. Their legal minds, their CPAs. I mean, just exhaustive due diligence, because guess what? They don't want to put their name on something that's not legal, that's not proven, and it's going to help. It's going to, they're going to lose their credibility, right? They're very cautious about rolling out, especially tax stuff with IRS. Like, it's really serious stuff. So guess what they found? 2 things, and it's the same thing I found, and it's humbled me. I found that the person I work with, he's the smartest person I've ever met. He's brilliant. He created the structure. He's a tax attorney and CPA. He worked for Arthur Andersen before the Enron crash. He's amazing. We call him the Beethoven of tax, the smartest person I've ever met. Studied underneath him for 10,000 hours over 10 years. It's been awesome. So they start looking with him. They spend 2 days with him. They come back with 2 conclusions. 1, that's the smartest person we've ever met. And that's much, much bigger than me saying that. It's them saying that, okay? Number 2, we're all in. We will use the Deferred Sales Trust and we'll become a part of the inner circle, and we will support financial advisors on their team that are serving the Deferred Sales Trust. Like Mitch is a financial advisor in Colorado. as an extra eyes and ears and as an extra level of expertise to manage ultra high net worth wealth, because that's part of what the DST unlocks for ultra high net worth individuals. So we're bringing the dream team to help support that. And so I always say to everybody who's a skeptic, and you should be a skeptic because you've never heard of this before, right? To ask yourself if it's good enough for David Young and his legal team, after 2 years of due diligence, of being in the business for 30 years, of running with Bill Gross and building up PIMCO, right? It's good enough for them. Is it good enough for you? And is it good enough for your legal team? And that's the simple big domino question and story that I just tell over and over and over again. And I have him on my podcast. You can go to capitalgainstaxsolutions.com. You can literally watch David Young's story. He's been on my podcast 5 times, and I think at least 3 of them were just talking all about this, his entire story and process to this. And in fact, you saw him in the very, very beginning video, and we're gonna wrap this up here in a few minutes. I'm gonna play the video one more time, and you're gonna see he's gonna say, "Hey, we were doing our due diligence as they were doing due diligence on us, and we went through this 2-year window process, due diligence, thorough investigation, and we put our name on it," right? And so that's really the question. So Pierce, does that make sense? There any questions on that?
No, the story, I mean, I've been using the David Young story for sure, just to try and build that more, credibility and whatnot. So I'm totally with you. Overcoming with stories is definitely the way to do it.
Rebecca, any questions on that?
Nope. Love the David Young story. Thank you.
Andrew, any questions on that? Maybe you've heard that story for the first time. Have you ever heard that before?
That is the first time for me, but it's a wonderful story. I know Bill, I don't know him, but I know of Bill Gross, and I respect him greatly. So that's a really cool story because his name has a lot of power in my mind over the years.
Perfect. Mitch, what do you think about that story? You're a financial advisor. You probably know Bill Gross, right?
Absolutely. Well, Pierce, so they were headquartered right there in Newport Beach.
Right.
So right up the street from you. And, that was part of Pacific Life. Pacific Life's one of the big insurers in the country on a corporate and individual investor level. And, Bill Gross I remember when he retired, and L. Arian, took over. And so these guys are all well entrenched in the industry. And if I didn't know that they went, I haven't seen the David Young story yet, but hearing that is that they put their intelligence out in front of just saying, okay, well, it sounds too good to be true, so it must not be. And they took the time to lay down the tracks to verify and make sure it would work. When I heard about the DST, so I had experience with charitable remainder trusts, I'm like, well, it makes sense because you're having the trust at arm's distance from the seller take the asset. So the seller is not taking constructive receipt. So for me, it made sense, but I'm still so new to this, but this is good stuff. I'm glad I caught this.
Yeah, so that's really the key here. Hopefully everyone who's listening to this and learning about the first time, figuring out this thing is legal, we want to give you comfort and get with David Young, right? And Pierce, in fact, I'll probably get you face to face because you're in Newport Beach. Just go get you a meeting with David Young so you can meet him face to face, and you can
that would be great.
Tell that story, right? Say, I've met David Young. I've been with him. I've met David Young. I've been with him. And he's a great guy. He's open, transparent, just fantastic individual. Really smart. He has an accent. He's originally from England. Just really cool. Really just a great, thoughtful gentleman. So that being said, I want to open up for any last questions that we have. We have just a few minutes left. Does anyone have any questions or thoughts or deal stories they want to throw at me? I'm happy to answer those and provide some last minute value before we wrap everything up.
Yeah, I've got a quick question.
Sure.
So last night I'm working with a broker and with Sean, and we're talking about a case that he's got. We discussed it before. And he said, hey, look, I've got this situation. They sold a 3-unit property in San Diego, and the check is currently in escrow. I told him not to take the check because he just found out about the DST. Is there any way they might be able to still maybe have the escrow company where the check is currently send that the proceeds from the sale to a qualified intermediary, and be able to basically keep them from having to pay the capital gains tax, which is around $400,000.
So it all depends if it's been recorded or not. So like if the deal's actually been recorded and like it's a done deal and the check's just sitting there and they haven't they haven't previously set up a 1031, then it's over. It's what's called constructive receipt. It's done.
Yeah, I think it is recorded.
Yeah, if it's recorded, it's over, right? And so, but if it hadn't recorded and they could set up a 1031 prior to and escrow said that's all good and everything is signed off on legitimately, and the funds were at now a qualified intermediary, then yes, on day 46 we can or day 181 we can save a 1031 exchange. We can provide a alternative versus paying the tax. In fact, we did. I think we've done like at least 7 in the past 6 months alone. Like do those. So yeah, so that's the answer, Mitch. And unfortunately, hopefully that's a deal story of what not to do, right? So I encourage you to go
that's
content.
That is 2 in 1 week.
Yeah, here's what not to do, right? Not have a plan, not have an alternative, not do due diligence. Also why we do a no cost, no due diligence process, no cost for any due diligence. We only get paid. I think Andrew had one last question before we jump off. Andrew, go ahead.
Just like, I know this is just gonna be a tip of the iceberg kind of question, but push a little bit more on that thing that you mentioned before about with a DST pushing money outside of your estate and the importance of that for the 40% death tax. I think that's important. I mean, I need to know more about.
Yeah. So let's imagine you're worth $52 million, or a client is, okay? And all 52 million is inside your taxable estate, and you are married, okay? So you have 22 exempt, but you have 30 million that is not exempt. So you die tomorrow, your wife dies tomorrow. 40% death tax on that 30 million, which is $12 million, you'll be hit with. No matter what the stepped up basis is, no matter what your capital gain, it's completely separate. It's a death tax. It's an estate tax. It has nothing to do with stepped up basis, nothing to do with capital gains tax, right? So it's a whole nother level. That's $12 million. They're going to have to pay the U.S. government for the estate passing. So the challenge is they have this $12 million. The challenge is they can't get it out fast enough. They don't want to buy a bunch of life insurance. This is really expensive. They don't want to give it all away to charity. They can't gift it out fast enough. So what's the solution? The solution is to literally sell. Let's imagine it was a $30 million apartment complex. They could sell it before they die, okay? Move it into the Deferred Sales Trust. Now all of that $30 million is outside the taxable estate. So upon dying, they've eliminated that $12 million estate tax because it was outside their taxable estate.
Yep. Wow. It's powerful.
Huge, right? And people just don't know about it, or it's too good to be true, but this is where you kill the David Young story. And the key is not to overcome by logic. Just really define the problem, tell a deal story, tell the David Young story, and then bring them onto the mastermind, bring them onto a one-on-one call, and we will do the heavy lifting, okay? And then you'll learn on the sidelines like a fly on the wall, right? And we'll learn. And then you'll get one under your belt, and then you start to roll these. This is my entire story. I sat there, I do nothing. I was sitting there like, I was just like happy to be in the room with the most smart people and just listening like, oh my gosh, just taking wild notes, chiming in where I could. And that's all I did. I was just like just a guy on the wall, just taking notes. And eventually I started to answer the questions, right? And then like anything, right? The first time you did a syndication, Andrew put a deal together or raised money, or Mitch, the first time you put an allocation together, or Pierce, first time you sold a home, or Rebecca, you built a house. Same thing, right? Just bring them to the table. Know that this is the future. This is the Netflix. And then with that being said, I got to jump on a call. So I want to wish all of you guys an amazing, amazing weekend. So Christmas Eve is the 24th. I'm still kind of like in between. I might jump on and see who shows up, right? I might get kicked in by my wife, but it's 10 a.m. We're all sitting at home anyways in COVID lockdown, California, right? Not really that bad, but so I'm going to be here next week, and we'll see who shows up. But if anyone wants to take action right now, you go to capitalgainstaxsolutions.com. If you have a deal that's $1 million net proceeds, $1 million gain, you can schedule a one-on-one consultation. We also have our YouTube channel playlist. It's all things cryptocurrency. And literally it's like, 20 videos you can start geeking out on right now. You watch that over the weekend, you're going to know 90% of this. We have the replays of these masterminds. Please invite somebody next week. Please bring your CPA, bring the skeptic. Let's bring them all together. I might even try to get David Young on here. How about that? That's a good goal for January 2022. I'm going to get David Young on this. So David Young, I'm going to see if I can get him to come on and tell his story. How does that sound, everybody?
Yep.
Cool.
All right. Thank
Super
you all.
cool.
Appreciate everybody. Talk soon.
Have a good one. See ya.
Okay. Bye. Actually, what we're going to do is we're going to play a video here because I did promise we're going to play one more video, and then that will be the end of everything. So let me share my screen. Share my screen and play this video. So you're getting a little extra here. This is my YouTube channel, if you're wondering. Here. Actually, let's play the David Young video. How about that, everybody? So I'm on my YouTube channel. And you can go to Overcoming False Beliefs with the Deferred Sales Trust. You click on this. And this is, here's the David Young kind of series. Let's play why everyone's not doing the Deferred Sales Trust. This is a good one right here.
It's the two edges of the sword that come with wanting to protect something.
It seems like it's too good to be true, David. You know, my CPA would have heard about this, right? I mean, why hasn't someone else told me about it? Why isn't everyone doing it? You know, and I don't know if you've heard that yet. I hear it about every day, but what would be your response to that?
And it's usually got an element of sort of not distrust or sort of, oh, hold on now, wait a minute now, you know, and so. It's the two edges of the sword that come with wanting to protect something. In order to protect something, anything, a great business idea, intellectual property with a patent, a transaction type, which in this case has certain legal and other protections, so that no one importantly can take the really good idea and go basically duplicate it. That's important. But more importantly, take the good idea and mess it up. So in a strange way, when you are protecting anything, right, it also places some limitations on its broad use. Not everybody can see it or access it. It's not perfectly transparent or out floating around on the internet. We expect everything to be Googleable, right? Well, this isn't Googleable, at least not in terms of the detail, because there's no way to do that and make it that broadly available without protecting it to make sure it stays, it's done right. Look, we had this conversation about the asset portfolio, where the nature of it is that the investments must perform within a range. And the range is fairly generous and there's some flexibility, but the point is, all of the parts, the legal structure, the tax elements, deferment elements, and the investment elements, they all have to work together in harmony, and they all have to perform. If any one of them breaks, then we have a problem, and it's my reputation, and it's your reputation, it's Bob Binkley's reputation, and these are serious folks. I think of myself as a fairly serious person through my entire life, developing my credibility and my reputation, and I'm not about to throw it away. So, in a strange way, the activity of protecting that sanctity results in the fact that it isn't as widely known as you otherwise think it might be. That's actually a good thing.
Right, it is actually a good thing, right? And it's why it's been 25 years now plus, thousands of closes, billions under management, over a dozen no change successful IRS audits, and because it's just an installment sale, right? Now we're created with a third party unrelated trustee, which is what the services we provide here at Capital Gains Tax Solutions. But it takes a team of professionals to execute this in a way that that maintains the law of IRC 453. And that's important to mention. By the way, we also think and believe and would hope to think that just the same fact that you can diversify the wealth, the IRS also says that could think and would believe that you're going to diversify the taxes being paid, right? Because this is truly deferral. This isn't avoidance, right? What we're saying is they're actually locking in the gain, versus the 1031 exchange where it's, right as it stands right now, it's kind of, you can drop into your swap or swap into your drop. And in 2008, when things were not diversified, and if you're trading one single asset for another single asset, taking on a bunch of debt,
guess what? Things can stop, and all of a sudden that gain gets wiped out. And guess who else who doesn't get the tax on that? The IRS. Whereas in the deferred sales trust, we're taking that gain and we're kind of locking it in and we're preserving it, right? And we're going to spread it across potentially 100 different investments in 100 different companies, right? From different countries, different areas, different, it can be real estate, it can be stocks, right? It could be hard money lending. It can be a number of things. And therefore it increases the chances of when you receive payment, you'll pay tax. Also, by the way, it gets new property taxes, right? Because the property sells. The agent gets the listing. He has to pay tax on the commission. So it's actually a win-win-win.
He knew every answer to every question without hesitation, but importantly was able to put it in such a clear and succinct manner that you knew he understood it at the very essence. Sometimes, and money managers are the worst, right? We go into what I call the mumbo jumbo, and it's the Greek letters, and the Sortino ratio, and okay, what exactly? It's like too much sauce on food. Like, what exactly are you trying to hide in there, right? Anyway, and so those were enlightening or sort of revelation sort of moments, and then I think I'm seeing the first one go from idea through the process and understanding, and I had an occasion to do this this was maybe 18 months ago, right? Start to finish, and just watching it as it unfolded and developed was also very helpful. And then separate to all of that, talking to someone that I knew, and I didn't even know this person was working with a deferred sales trust. It's a college buddy of mine who lives in the area, and then chatting with him about his experience. And so I got to see it from the technical aspect, the practical application, and then the user's aspect. This person was selling a highly appreciated home right here in the area, and it was just enlightening to see his take on it. And so those three things all came together.
Excellent. Thanks for sharing. And so, yeah, by the way, you can go to capitalgainstaxsolutions.com to learn more about the deferred sales trust. And if you're a client who's already listening to this, we would love to bring David on because, by the way, he can help. He's an option to help manage the funds. That's part of what his team does. And our goal here at Capital Gains Tax Solutions and also the estate planning team, the goal is aligned with both organizations to try to provide what's called a dream team. We want to bring some of the best wealth advisors and real estate ideas and try to help you create and preserve more wealth. And that the Deferred Sales Trust is the tool, and the team helps to execute all of this. So you can go to capitalgainstaxsolutions.com. That being said, okay, so you went from 2-year due diligence, you see the technical, you see the practical, you see the application with the user who's selling a high-end primary home in Southern California, and now fast forward, I don't know, maybe that's a year or two ago now. I'm not sure quite on the time frame of all of that, but why is the Deferred Sales Trust so important or so powerful right now for high net worth individuals selling assets that are highly appreciated?
So what would I say? I would say, number one, taxes aren't going down. I think we can all probably agree on that. Some might debate that, but I can tell you as an economist and a market watcher and someone who, reads policy statements from, administration, state, federal, see the amount of debt being issued. We see it all. And I think taxes aren't going down. So if anybody were waiting for a better tax environment to sell, be it stocks or a house or a collection of cars or whatever life happens to bestow on you, that strategy is probably not going to bear fruit. Yeah. Number one. Number two, I think diversification is important. It's always important. I think it's more important now. Here's what we've seen, especially in environments where there's so much liquidity and just money sloshing around. Certain parts of the market, we're seeing them get very sort of, overstressed. Other parts, there's still a lot of opportunities out there. The real estate market is strong. Prices are up. That's good. I do always laugh sometimes in the stock market. Clients will say, well, I do want to reposition my portfolio and get more diversified. But I have a lot of, gains. I have a lot of capital gains in these stocks. And I don't want to pay all those capital gains taxes. So now this is specific to the stock market. So I want to wait for the stock prices to come down. So you made a lot of money. And rather than pay a little bit, we could argue maybe more than you should, that's for another day, to the government, you want to wait till you give back some of your gains to the market. This is not a good strategy. So I think diversification is always important now, maybe more so than ever. Those two things I think come together most powerfully. And then I think this ability, as I said before, to get liquidity, as it turns out, as we discovered, back in 2007-8 during the great financial crisis and the aftermath, we discovered it again in a very cold water splash in the face in March, April, and May of last year. Remember where we were right around this time last year, right? The wheels were coming off and liquidity was king. And we always underestimate the value of liquidity until we need it and don't have it. So here's a way to get that liquidity, get that diversification. And then the last part I mentioned before, I got ahead of myself as I sometimes do, time horizon, right? Is to then say, now we can put this money in an instrument and, for this 10-year period. And then of course it can be extended. It can basically be rolled over after that. Buy ourselves the most important part, which is control, transparency, diversification, and the ability to move that money around based on what's happening in the world, be it inflation coming back, interest rates going up, stock market going down. All these things are coming. I just don't know exactly when or in what order. But the Deferred Sales Trust allows us this insulator to do all that, maximize return before taxes, and let the investor, let the client decide when they want to realize how much of those various proceeds. It's very powerful. It
is powerful, which leads us to the next question, which is this: it seems like it's too good to be true, David. My CPA would have heard about this, right? Why hasn't someone else told me about it? Why isn't everyone doing it? And so I don't know if you've heard that yet. I hear it about every day, but what would be your response to that?
And it's usually got an element of sort of not distrust or sort of, oh, hold on now, wait a minute now, and so it's the two edges of the sword that come with wanting to protect something. In order to protect something, anything, a great business idea, intellectual property with a patent, a transaction type, which in this case has certain legal and other protections so that no one importantly can take the really good idea and go basically duplicate it. That's important. But more importantly, take the good idea and mess it up. So in a strange way, when you are protecting anything, right, it also places some limitations on its broad use. Not everybody can see it or access it. It's not perfectly transparent or out floating around on the internet. We expect everything to be Googleable, right? Well, this isn't Googleable, at least not in terms of the detail, because there's no way to do that and make it that broadly available without protecting it to make sure it stays, it's done right. Look, we have this conversation about the asset portfolio. Where the nature of it is that the investments must perform within a range. And the range is fairly generous and there's some flexibility. But the point is, all of the parts, the legal structure, the tax elements, deferment elements, and the investment elements, they all have to work together in harmony and they all have to perform. If any one of them breaks, then we have a problem, and it's my reputation, and it's your reputation, it's Bob Binkley's reputation, and these are serious folks. I think of myself as a fairly serious person. So my entire life developing my credibility and my reputation, and I'm not about to throw it away. So in a strange way, the activity of protecting that sanctity results in the fact that it isn't as widely known as you otherwise think it might be. That's actually a good thing.
Right, it is actually a good thing, right? And it's why it's been 25 years now plus, thousands of closes, billions under management, over a dozen no change successful IRS audits, and because it's just an installment sale, right? Now we're created with a third party unrelated trustee, which is what the services we provide here at Capital Gains Tax Solutions. But it takes a team of professionals to execute this in a way that maintains the law of IRC 453. And that's important to mention. By the way, we also think and believe and would hope to think that just the same fact that you can diversify the wealth, the IRS also says that could think and would believe that you're going to diversify the taxes being paid, right? Because this is truly deferral. This isn't avoidance, right? What we're saying is they're actually locking in the gain, versus the 1031 exchange where it's, right as it stands right now, it's kind of, you can drop into your swap or swap into your drop. And in 2008, when things were not diversified, and if you're trading one single asset for another single asset, taking on a bunch of debt, guess what? Things can stop, and all of a sudden that gain gets wiped out. And guess who else who doesn't get the tax on that? The IRS. Whereas in the deferred sales trust, we're taking that gain and we're kind of locking it in and we're preserving it, right? And we're going to spread it across potentially 100 different investments in 100 different companies, right? From different countries, different areas, different, it can be real estate, it can be stocks, right? It could be hard money lending. It can be a number of things. And therefore it increases the chances of when you receive payment, you'll pay tax. Also, by the way, it gets new property taxes, right? Because the property sells. The agent gets the listing. He has to pay tax on the commission. So it's actually a win-win-win. So would you dispel maybe where folks think it's not a win? And any thoughts on that, on David with the IRS?
Well, I want to make sure I'm answering the right questions. So, folks who, I haven't had a lot of people who come to the conclusion that it's not a win-win as you described, and as we both described. Probably because I'm a little bit further down that food chain, right? So if they're not seriously interested and haven't overcome many of those, initial concerns, we've talked about a few, which are all pretty easily dispelled, I believe, then I don't have a lot of interaction with them. They never kind of get far enough down the path for me to talk to them about, okay, now what do we do with the assets? Yep. I can tell you in the ones I've been engaged with, I've got nothing but, happy clients. I don't want to over answer the question.
Yeah, no, that's exactly right. And which leads to the next one. What is the deferred sales trust? It seems too complicated, right? It's too good to be true. Okay, we figured out the legal, it's proven, it's done. Okay, but the next thing is, but it's just too complicated for me or my advisors to understand. My counter to that, I'm curious what you think, David. It's, well, they haven't done it yet, or their clients haven't done it yet until someone's done it that they know. And kind of like your story, right? Where you said you had the technical part of it, you had the practical part of it, and then you had the application with a friend of yours, right? And you're saying, okay, all three, and that helps to solidify that. And you can't also beat them up too much, because sometimes they're calling us with 30 days to go, right? And this is a $10 million business sale. All of a sudden they're looked up and they're like, oh my gosh, I'm going to have a $4 million tax liability. Oh my gosh. And it's such an emotional big thing. And they go, I don't understand everything over there. So I'm just going to either A, not do it, or acquiesce to what my CPA says, who's never seen it either. So just walk through and try to put us, if you're in their shoes, David, right? Not trying to take us out of it. Being in the industry, 15 years, you're 30 years, take us out of it and help the client right now who's looking at this and saying, I just don't fully get it. How do I know I can trust that I'm going to be okay?
So let's see. And Brett, I'll ask you to chime in here a little bit too. We can kind of tag team on this one. It's funny. Someone, at least in terms of conceptually, compared and contrasted a deferred sales trust with either a basic IRA or a self-directed IRA, where someone might elect to purchase a piece of real estate in your IRA, which you can do. There's such a thing as a real estate IRA, right? And it's just like the other one, except it's buy real estate in there. And now there it's different because it would be an initial purchase, or you'd be investing in something that hadn't appreciated yet. But if you forget about that part, right? What is it really? It's an IRS tax code, just like 401k and the IRA tax codes, right? There's a bunch of them, right? Which basically says that if you're investing money or owning an asset for these set of purposes, which we believe to be, good, retirement, whatever the case might be, right? There's some elements of kind of the tax code wanted to incent, the right kinds of behavior, and you open up this particular type of an account and it's conforming, right? It's got to meet these different rules and regulations. That if you put an asset in there, you could buy one share of stock or whatever, put an asset in this instrument, it will grow tax qualified. In that case, we say tax deferred, right? Until such time, and there's some other conditions about age, which aren't part of this. That's because that's a retirement, right, vehicle, whereby you can defer payment of taxes. When you turn a certain age or choose to take it out, there might be a penalty if you take it out. It's really not different. It's if you keep it super simple, the only difference is here, rather than putting $1,000 in an IRA and then going out and buying some stock or some bonds, and then we start this whole journey, right? Here you're putting in something you already own. Then there's a note that comes back representing your ownership. There's a trustee overseeing it, right? There's all these different parties who are in place to manage it and make sure it does what it's supposed to do. It's really fundamentally no different. And so when you boil it down to its simplest comparative wrapper, something like an IRA, which we're all very familiar with, most of us are very familiar with, I think you demystify it.
Very well said. Yeah, I couldn't say it any better. Couldn't agree with you more. And this will be the last one here on the Deferred Sales Trust, and then we'll shift a little bit to what's going on with this. How does this bull market end, if it does end, and touch on Jay Powell's announcement to not raise interest rates for the foreseeable future. We'll touch on that here in a minute. So this is the last one. Is the DST is just too expensive with the ongoing fees, David, or I guess maybe it could even be for wealth managers like yourself, right? Your fees, they're so expensive. And so I'll give an example. Someone's selling we just did a deal in the Santa Cruz area. It was a $7.9 million sale, and they had about $2.6 million of liability of tax. So they paid off debt, by the way, of about $2 million, and they put about $6 million or so into the trust and deferred the 2.6. And they go, how can you charge, this? And that deal, I think it's somewhere around 1.3 or 1.4% on an annual basis, recurring, and the setup fee is about 1.5% of the sales price. You have a little bit of a break over $1 million. But that being said, just give us from the fee of the forest or the tree versus the forest, right? And how would you if someone's in the shoes right now thinking it's too expensive, what would be your response to that?
I think here's what I would do, is I would take a step back and think about the expenses related. I would do three things. I would do what we call basically a holding period return analysis. So one investment says, if I understood you properly, you make the transaction, you defer 2.6 million in taxes, you're left with 6 million, right? And then I would say, well, what are 2.6 million in taxes deferred as a function of the initial sale amount, right? That percent, divide by 10. Assume a 10-year holding period. We can all do that math, right? Do that right now. So that's going to be a number. And I would compare that number to the original initial setup fees, right? I think you mentioned, maybe is it 1.5% setup, right? Okay, divide that by 10, because even though you pay it up front, the reality is it's buying you this 10-year long transaction. Divide that by 10, goodness gracious, that's like a fraction, that's 15 basis points. It's very little in the grand scheme of things. And then I would add that to your annual running costs to manage the money and have the trustee oversight and all that. I think when you compare those, I think you will find out that the break-even rate, right? The amount of time it takes you with some reasonable rate of return, whereby the upfront fees to set up the trust plus the running fees over that break-even period of time compared as a percent to the taxes you saved spread out over time, your break-evens look like a couple of years, not even. I mean, and then after that, you could argue, right? I'm not saying it's free, but you could argue all the time after that break even where expenses cross tax savings, that's free. The trust and the transaction is in effect free to you, the investor. And so that's the way I would look at it. I don't think you can say, I would have to write a check for this for legal, and a check for that for accounting, and then pay ongoing management fees and trustee fees. You have to pick a period, make it 5 years. 10 years is the normal trust period, and just do that very simple back of the envelope math. It doesn't have to be rocket scientist. Don't worry about compounding of interest and all that. Just do simple straight line arithmetic. And I think you'll find that break even is really very early on in this transaction type, and the rest is, you could argue, gravy.
Beautiful. Let me see if I can encapsulate that. And that was just so articulate and so well said. And I love the way you broke that down. So you take the liability, let's say 2.6 million, and you divide that by the price, right? The 7.9 million, or the asset sales price. Or even in this scenario too, I would also maybe wonder if you do it by the net proceeds, because they're going to pay off about 2 million of debt, so let's just put it at 6, and you divide that by 10, that gives you a number. And then you're going to take the 1.5%, let's say that's the number, and you divide that by 10, and you go, okay, that's about 15 basis points. Let's assume a 10-year period of time. And then we're going to do the plus the annual running cost. And at a certain point, you're gonna compare contrast those two versus just paying the tax, and you're gonna get a break even rate where essentially you say, okay, this 2.6 that I would have paid, I'm earning interest on this net of the recurring running cost fees, and it breaks even at 2 or 3 years, and then after that it's all free, or it's no longer costing me, right? My return on my investment on this, if you will, is now infinite returns. Is that a fair summary?
Yeah, fair summary. A couple of things, caveats. So whether or not you do the 2.6 in tax savings on the original sale amount or the base, that could be debated. You could do it both ways. It wouldn't take long. It's just a pencil and a calculator or Excel. You would want to assume some rate of return for the monies that you didn't pay on taxes, but in fact invested, right? Here's the very simple point. Just in a simple snapshot, assume you have an extra 2.6 million. Cut right to the heart of the matter. You would have had the other money anyway, so assume marginal only. Assume you have 2.6 million more than you would have because you didn't spend that on taxes. Now, 2.6 million, taking into account, call it 1.5% per year. That's on 2.6 million. You're talking. Yeah, I came to the math in my head, unfortunately, very quickly, but you could assume that 2.6 million earns, something very conservative, 5% a year. I think we could all figure out that, 5% on the 2.6 million savings is clearly more than what all these other, what the other startup and running fees are on the total amount. Right. That's kind of the break-even analysis.
Excellent. Very well said. And for those who want a full analysis, you can go to capitalgainstaxsolutions.com, and we can customize that for you. By the way, we don't charge anything for anything unless and if you close the deal. Unless the deal actually closes, so it's no cost, no obligation, due diligence period. All that being said, now let's shift to part of this episode now, which has to do with how does this bull market end? We're now recording this March the 17th, 2021. Jay Powell came out today and essentially, and correct me if I'm wrong, said that there's no in the foreseeable future raising of the interest rates. Of course, it could change. Things can change, but he doesn't anticipate that. First of all, give us that summary, confirm that for us, and then let's chat about what are some key indicators that you'll be looking at to gauge that things are staying healthy as they can be, David.
Sure, quite a lot to unpack there, and as you might imagine, entire shows are made up. If you watch CNBC, at the end of the day, it's one show after another talking about these types of things. So let's see if we can't boil it down into simple terms. Context and history always matters, and so here's what I would say. If we're asked, how does an economic expansion eventually, kind of roll over and turn into a slow period and then ultimately a recession? How does a rising stock market, we'll just call that a bull market in assets, risk assets, eventually sort of slow down and then retreat as is the cycle? It's never exactly quite the same every time, and that's because the preconditions that started that economic expansion or that bull market in assets are never exactly the same. They can't be. It's just not possible. So if we want to know where we are in the cycle, and most importantly, so we can try and figure out how much further, it has to go, we have to spend a minute and figure out how we got here. And I'm not going to go into a big, economic and market history lesson, except to say we still to this day have material remnants of the great financial crisis of 2006, 7, 8, really. And that is a condition of a tremendous amount of liquidity, excess liquidity, I would argue, with, inflated central bank balance sheets, because right around that time, they stopped being pure referees and started being combatants. Imagine central bankers, taking off their striped jersey and donning the jersey of, maybe the jersey of one team and the helmet of another, running onto the field. It changes everything. And even the rules started to change a little bit. And so that was a really important period. Well, that's still with us today. You have a very active Federal Reserve in the markets more than ever before. You have this overhang of liquidity from 10, 11, 12 years back, something like that, more. And then you have COVID, which is a pile more fiscal activity, right? Spending by the government, more activity by the Treasury, more activity by the central bank, all of the kind of, the authorities in this game that's being played, combined with a tremendous amount of liquidity being pumped into the system. And that liquidity was the right thing to do. We had to shore up asset markets and credit markets and the consumer and small businesses. And now we have the $1.9 trillion additional stimulus package. I'm generally in favor of these measures. Only time will tell if it's too much. But funny thing about medicine, if it's too much, you can probably deal with that problem. If it's not enough, you have a whole different problem, which is the patient doesn't get better. The patient actually gets sicker, right? And so that's something we're going to be watching. But so the run-up, that 10, 12, 13, 14-year period of how we got here matters a great deal and affects how this ends. And, we're watching, and the end is not near, don't worry. We're watching, 7 or 8 different factors to give us a sense of when, both the economic expansion and for people listening in here too, and for the Deferred Sales Trust investors, when the bull market in assets might end.
Let's focus on maybe one or two that you feel are the most crucial out of the 7 or 8.
Mm-hmm. Sure thing. Well, see, in my business, maybe like many businesses, you develop these age-old adages. I mean, how exactly old they are, I don't really know, but they're old enough to be called age-old adages, and and there are a couple that I firmly believe in. Number one. Economic expansions don't turn into recessions of their own length or breadth or magnitude. It's not like there's some magic tipping point that says, and you'll hear people say, well, there's 22 consecutive quarters of growth. That would actually be quite a long run, right? Of growth. And that's the longest it's ever been in the post-war and blah, blah, blah. That doesn't matter. Every one of these is different, right? And as soon as you set a record, you better believe that you're just setting a basis on which to set another record. That's how the world and life works. So, we don't spend a lot of time looking at the length and breadth of economic expansions to try and determine when they end. What I can tell you is they end usually because of one main reason, and that is central bank or banks, we'll just pick on the Federal Reserve because we're here in the U.S., raising interest rates too far, too fast. And basically, maybe it was to pump the brakes, to slow economic expansion. They hit them a little bit too hard. The economy slows, more abruptly and dips into recession. And then sometimes it's the follow-on knock-on effects that makes that worse, right? And you get a really serious recession. The Fed does not plan to create really serious recessions, but this is also like trying to steer a very big thing without all the tools you certainly might want in a perfect world. And so that's first and foremost. There are other kinds of causes to an end of recession, of an expansion. I'm sorry, the beginning of a recession. We used to have one listed as number 7, way down at the bottom, and it was global pandemic. And people went, global pandemic? That's silly. Global pandemic. That's never going to happen. Oh, wait a minute, it just did. So, and why do we talk about the end of economic expansions and the reasons why they end? And the number one cause being the central bank raising interest rates, is because the age-old adage says that bull markets in stocks, right? The stock market going up, NASDAQ going up, all these Dow going up, S&P going up, also doesn't just run out of steam and end, right? What ends up happening is something stops them. And usually what stops them is a recession. So watching what is probably going to bring an abrupt end to this, or at least an end to this bull market, is really a lot about watching what's happening in the environment in which the stock market operates, right? It operates inside of a global and a U.S. economy. So those two things are attached at the hip. They're not the same, but they're attached at the hip. So with that backdrop, you could probably guess the first couple things that we're looking at, but I'd be happy to summarize them for you, Brett.
Please do.
Yeah. So, and we'll break this down by what's green. What's green right now, meaning we're not worried about it, meaning it looks fine. But if one of these three things were to turn yellow or red, we would start to get worried fast. Number one, the expansion appears well entrenched with a lot of good forward momentum, no recession in sight. We just talked about the importance of recessions in this whole scheme of things, number one. Number two, there is very little sign, if any, in fact, quite the contrary. There's confirmatory and affirmatory statements even today by Chairperson Powell that the Federal Reserve is not planning on hiking interest rates at any point in the kind of foreseeable or actionable future, right? That was not a surprise. We expect the Federal Reserve and other central banks to leave this liquidity in the system to keep kind of trying to fuel economic growth and COVID recovery in all the different forms it takes. And so that's a bright green indicator, no problem there. So what do I think is going to really matter this time? There's a few, but a change in investor sentiment. Right now, investor sentiment is green. You see it every day. In fact, so green, it's like flashing neon, sparkly, bedazzled green. It's really green, right? Everything is a reason to buy. Everything is a reason to buy the dip. Oh, I just got hammered in my whatever. I'm going to buy more. I mean, that's the only solution. You buy more, right? Well, that isn't always the case. Ultimately, or at some point in time, investor sentiment will shift. And rather than buying those dips, which would obviously help, keep a market up, people will turn to selling those dips, and it can turn very quickly. So we're going to watch for things that might change investor sentiment from buying the dips to selling the dips. And for us, that's things like asset valuations getting very high. It's things like recession we talked about. It really has to do with things that affect the U.S. consumer psyche, unemployment, and other such things could very quickly just backwash right into the consumer, who is the investor's sentiment. Remember, the economy is made up of people, and the markets are made up of people. Those are the things we're watching. But right now, our dashboard's, largely green. A few indicators are flashing a little bit of yellow. Nothing is really red to speak of, except some of the frothy behavior around certain individual stocks and parts of the economy. So we think 2021 is going to be a good year for returns.
Amazing, David. I mean, yeah, a whole dissertation, a couple books right there. And I want to just thank you for being on the show. We have run out of time. We've covered so much. For our listeners or our clients or people who are looking at the Deferred Sales Trust, they want to find out more about you, David. Would you give them the best website or the best way to connect with you?
Yes, we are very simple. It's just Anfield. And I always get this wrong. Are we Anfield Capital or Anfield Group? I don't even know my own website. It's embarrassing. Or it's AnfieldCapital.com.
Yep, AnfieldCapital.com. I'm looking at it right here.
We have
And
more than one, but I want to make sure you give it the
so
best.
you get paid the big bucks, not to
AnfieldCapital.com.
get all the websites, right? You get paid the big bucks to analyze all of the numbers in the marketplaces, right? So yeah, you can
Right.
find more about David Young, CEO of Anfield Capital, at AnfieldCapital.com, and I'm going to put that here right now on the below the show notes here. So AnfieldCapital.com. And if you want to learn more about the Deferred Sales Trust, you can learn more at CapitalGainsTaxSolutions.com. That's CapitalGainsTaxSolutions.com. And that being said, David, I want to thank you again for being on the show, sharing a bit about your story, giving us so much wisdom, helping us to overcome false beliefs with the Deferred Sales Trust, giving us tangible indicators to take a peek at, keep an eye on. Right now, it's staying green. We're like for most stuff, but it certainly is a time to be aware of what's going on. And these are the type of podcasts we like to produce, so you have some good content to think about. Okay, so that being said, I want to thank everyone for listening to another episode of the Capital Gains Tax Solutions podcast. As always, we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy. Using a proven tax deferral strategy such as the Deferred Sales Trust, and hiring and bringing on groups like Anfield Capital, especially if you're a financial advisor, by the way, I forgot to mention this. They help financial advisors, they're money managers for financial advisors. That's typically the flow of how Anfield Capital works. Is the best way to grow your business, help your clients, grow your wealth. With that being said, thanks again for watching or listening. We appreciate everybody. Bye.